Hi everyone, and welcome back to the Independent Dollar as we make our way through our February tax tips and updates series. If this is your first time with us, we make weekly videos on personal finance topics in a way that's straightforward and easy to understand. Today we're focusing on understanding the taxes surrounding ETFs and mutual funds. We're also going to take a look at ways that you can reduce your tax footprint, either through a change in structure of your investments or where your investments are held. When we think back to our most crucial investment decisions, most of the time we focus on the underlying investments. How much should we invest in equities, real estate, fixed income? Should there be more Canadian or less Canadian focus? What is the cheapest fees or the best historical performance? But one crucial decision that is often overlooked is the tax treatment of investments. Before we dive into it, let's take a quick look at some of the various taxes that may result from income or gains earned within your investments. Now, for the most part, we think of paying taxes on the income you earn when you sell an investment. However, your mutual funds and ETFs will distribute a combination of interest income, dividends, and capital gains throughout the year. A dividend income or monthly income product will have regular payouts, either monthly or quarterly, as these products are meant to generate income. Other products such as US equity funds or ETFs may not have regular payouts, but instead will pay one large lump sum of all the dividends at the end of the year. There is also a scenario, which we'll discuss a little later, when comparing ETFs and mutual funds, where there is an additional lump sum paid out to investors. Interest income is treated as regular income, meaning it's taxed just the same as your regular salary is. Someone who's sitting at the top tax bracket will be taxed at almost 54%. Now, most dividend income, with only a few exceptions, will go through a dividend gross-up and tax credit. So a similar individual living in Ontario at the same top tax bracket will pay closer to 40% instead on the same amount of income. Lastly, with capital gains, you're taxed at only 50% of what you made. So that would effectively reduce your tax rate to approximately 27%, assuming you're sitting at the highest tax bracket. As you can see, the various ways that your investments distribute income to you can have an effect on the total amount of money that you'll have after taxes. So here's some quick tips on how you can reduce your tax footprint. The first tip is holding your investments in a tax-sheltered account. In Canada, those will be your various retirement accounts like your RSP, your LIRA, TFSA, and so on. If you've maxed out the contribution room in both your tax-free savings account and your RSP account, or maybe you've made the decision to hold some of your money in non-registered accounts, you really want to be selective as to which products you hold. As we saw previously, the tax treatment of interest income, typically found in income products such as bond funds or bond ETFs and GICs, will be taxed at the highest level. It might be wise to keep a larger portion of those investments in tax-sheltered accounts, while your equity funds or ETFs remain outside. However, equity funds and ETFs may generate more capital gains and dividends in the long run, so there is a trade-off in short-term versus long-term taxes. Next up is foreign investments. So at this point, we've now established that you really want to hold as much of your investments inside a tax-deferred or tax-free account as possible. What we haven't taken into consideration, though, is the withholding taxes on foreign investments. A withholding tax is a set tax amount or rate that a country will hold back from payouts to clients who are investing from another country. A great example of this is a Canadian who purchases a global equity fund. Now, the fund itself will invest in various stocks around the world, but whenever each of the individual stocks pays out a dividend, the government will withhold a set percentage, like 25%, back in the form of taxes. Many countries have tax treaties set up with their largest trading partners to help limit the additional taxes, or have provisions for tax credits. Canada has a tax treaty with the United States where US stocks held within an RSP will not be subjected to withholding taxes. This treatment, though, does not extend to our other tax-sheltered accounts like your TFSA or your RESP. So the preference really is to hold those investments within your RSP account. However, where things start to change is with Canadian mutual funds and Canadian ETFs that invest in the United States. These products are not exempt under the tax treaty and would therefore have to pay withholding tax. A solution to this could be to purchase US-listed ETFs instead of the Canadian ETFs investing in the United States. As of right now, according to the Canada-US tax treaty, US-listed ETFs would be exempt from withholding taxes inside of your RSP account. As for mutual funds, though, currently Canadian investors are restricted from purchasing US mutual funds, so unfortunately, there is not a similar solution available. You've now moved as much of your investments into tax-sheltered accounts, converted your US equity mutual funds into US-based ETFs, and allocated them from your TFSA to your RSP, alongside with your fixed income to take advantage of the favorable tax treaty and unfavorable tax rate on your ordinary income from your bond products. Our third and final topic is special distributions. Within a trust, such as an ETF or a mutual fund, there are transactions of buying and selling the underlying securities throughout the year. These results in various capital gains or losses and other investment income. At the end of each calendar year, the funds will distribute these to unit holders of the ETF and the mutual fund, and they're known as special distributions. When comparing an ETF to a fund, there are distinct advantages to using an ETF to reduce these surprise payouts, which in some cases can be significant. With the structure of a mutual fund, as new investors purchase or existing investors redeem their holdings, there is a creation or destruction of units of the fund. Most funds will keep a set amount of cash on hand to handle these regular flows, but any drastic moves will result in additional trades, triggering either capital gains or capital losses. On top of that, mutual funds for the most part are actively managed, which means the portfolio manager is buying and selling securities throughout the year. This will also add to the capital gains or losses of the fund. So how does that compare to ETFs? ETFs are traded on an exchange with a limited number of units. This means they do not create or destroy units when someone is buying or selling like a mutual fund does, nor do they need to invest extra capital or raise capital for investments. On top of that, most ETFs are linked to the holdings of an index or a set list of securities, so the underlying holdings are not traded as frequently, again reducing the amount of gains or losses being triggered, leading to smaller or non-existent year-end distributions. Now, that last point is not entirely true for all ETFs. We've seen actively managed ETFs gain a lot of traction in the last year, and they would suffer from the same tax issues as an actively traded mutual fund. As well, there are mutual funds called index mutual funds, which mimic an index, so you really need to be cautious of what you're purchasing. Hopefully this video has been helpful in breaking down a topic that can sometimes be really confusing. In all these situations, speaking with a licensed professional can help guide you to make the best investment decisions. Stay tuned for our next video where we'll be covering a few commonly unknown and expensive tax rules that you might not be aware of. Thank you so much for watching, and we'll see you back here on Tuesday.